Hello everyone, welcome to Marketing 452 International Marketing. This is chapter 12. Chapter 12. In this chapter, excuse me, let's talk about the international marketing, pricing of international marketing, right? Pricing for international and global markets. How do you price your products and services? And you see that obviously there is currency issues, there's the exchange rate issues, and tax issues in pricing your products and services. Mhm. The learning objective of this chapter is that afterwards you'll be able to differentiate between full cost pricing and marginal cost pricing, okay? And explain the implications of both to global marketers. Know how international transportation costs, tariffs, taxes, local production, and channel costs all affect pricing. Explain how different income levels, buying power, and competitive situations in national markets can require different pricing strategies across these markets. Compare and contrast the ways in which exchange rate fluctuations, inflation rates complicate global pricing. Okay? List various examples of government price controls that global markets might encounter. Define dumping and describe how it can constrain pricing strategies. Understand how the credit and collection infrastructure of country can affect pricing. Okay? How global marketers can manage export price escalation, determine transfer prices, and effectively quote prices in foreign currencies and parallel imports, credit and collection infrastructure, and different forms of counter trade, and balance the risk and opportunities of dealing with non-cash exchanges. Okay, lots of concepts here. Chapter on the outline, we talk about the profit and cost factors that affect pricing, the market factors, environmental factors, and managerial issues in global pricing. Okay? So overall, there's company internal factors you need to take into consideration: profitability, transportation, tariff, tax, production costs, and channel costs. Then there's the market factors: income level of the people in the country, buying power, there, and competition. Environmental factors: foreign exchange rate, right, inflation rate in the country, price control mechanism in the country, and the anti-dumping regulations that all affect your global pricing strategies. And also you can do by market pricing, right? You can do uniform pricing, okay? There are also managerial issues you need to consider: transfer pricing, foreign currencies, parallel imports or green markets, export price escalation, and global pricing. And these are all your decision making, right? These are your analysis in the global markets, coming up with a global price. Okay? Again, in pricing, there is the issue of adaptation versus standardization. Okay? Adaptation versus standardization, okay? Just like in product. Price standardization advantages. If you have a standardized price, there are advantages. Right? It's simple in planning and budgeting. You can develop a global brand image. It costs the same everywhere. It serves global customers with one price, make it easy. And you can meet local buyers' price expectations created by travel, by global media, by internet, and by international operations. Yeah. Can prevent gray trade. We'll get to that later. Okay, gray trade. Excuse me. If you look at the luxury watch brand global, look at their global prices. Okay, like this Hublot with watches, they retail for $10,000 to $1 million. $1 million for a watch, right? Well, somebody is paying for that, right? Raymond Weil watches retail for $500 to $5,000. Okay? Prices in India were higher than other markets because of 40% the import duty. But the Hublot and Weil absorb the duty in India to keep their watch prices uniform globally to keep the same image. Again, 10,000 to $1 million a piece for a watch. And think about that. Okay? But there are pressures for you to adapt to your price for global market and competition and the corporate strategy. Okay? Competition may force you to adapt. Local production and operation costs, okay? Economic development of the country, the government regulations may ask you, may force you to adapt. Okay? Transportation costs, right? Tariffs, taxes, right? Distribution, the middleman may may impact your cost, and also exchange rate fluctuations. The country's currency is not stable, then you may have to adapt. Okay? And profits and cost factors. Yeah, there are profit and cost factor. Of course, you have to cover the costs, right? And make a profit. Okay. First, there are the now here something here are the things that you should have learned from your accounting class. Okay, and make sure you have that, and maybe you still have your old textbook. Take it out, check it out, reread it, get a better grip of that. Okay, there is a fixed cost. The fixed cost will not change over a given range of output. You have to pay. Okay, there is a variable cost that varies directly with output in production, how many units you produce. Okay, and there is a marginal profit. That is the amount in excess of variable cost. The marginal profit is used to offset the fixed cost. Here example profit and cost calculation for this company, Western Machine Tool. So their selling price per unit is 60,000. Okay? Selling price is 60,000. Okay? And then they have a direct manufacturing cost of labor 10,000, materials 15, energy is 1, and together is 26,000 in direct manufacturing cost. Then the indirect manufacturing cost, supervisor salary 5,000, R&D 3,000, overhead 5,000, altogether 13,000. Okay. Then there's a general administrative cost, general administrative G&A from corporate 10,000, sales and marketing overhead 5,000, that's 15,000. Okay. So the full cost is add all three together, 26, 13, 15, you get 54,000. 54,000 out of the 60,000 in selling price give you 6,000. That's net profit before tax. Okay, this profit and cost calculation for this company, machine tool, Western Machine Tool, 6,000 profit. You can also look at the marginal profit calculation for Western Machine Tool. Okay? You can look at it differently. The selling price is still 60,000, but you have a variable cost versus total cost. Right? So your variable cost, right, from direct manufacturing cost of labor, material, energy is 26,000. Right? Total variable cost is 26,000. Then 60,000 minus that gives you 34,000. We call that a contribution margin. The selling price minus variable cost. Why it called contribution margin? What does it contribute to? It contributes to offset your direct cost. Yeah, direct cost. Yeah. I'm sorry, not your fixed cost. Sorry, not direct cost, fixed cost. Okay, variable cost, and then sales price, variable cost, contribution margin. To get contribution margin is used to offset your fixed cost. Okay. What are the factors that you need to consider in global marketing? You need to consider obviously your transportation cost. Right? There's a variation in pricing among transportation method. Sensitivity of transportation cost to price of oil is obvious. Right? If cost is higher in oil price, your cost is higher. That's a huge factor. Okay? Another factor for profit and cost is tariffs. Tariffs. What's tariff? Taxes on import export. still significant for certain products in particular markets, despite despite the efforts of GATT and WTO. There's still a big factor tariffs. Price escalation efforts. Right? Sometimes you may want to reclassify to avoid or lessen costs. The Land Rover's Range Rover, what do you think? Is it a luxury car or is it a truck? And the company actually argued that it should be considered as a truck, light truck, to avoid this 25% luxury car tax tariff. But they were successful in doing that. Okay? And next, let's talk about taxes. In some European countries, they have value-added tax or VAT. Value-added tax is assessment based on production value added, added value. And in 2002 European Internet tax, that non-EU companies must register in the EU nation and pay taxes on all Internet sales. There are also taxes called the sin taxes, that assess on products that are legal but discouraged by society, like tobacco, alcohol. This is a European VAT rate, value added tax rate. Yeah, this is a older numbers, right? But you can see it's a pretty high. It's very high tax rate. In Sweden, that's right, 25%. Belgium, Bulgaria, Portugal, around 20%. Switzerland is lower, about 7-8% in the VAT rates, VAT tax, value tax. You also consider local production costs, operational costs for raw materials, wages, energy, and financing differ widely from country to country. Okay? Channel costs, channel distributions, different channel lengths, distribution margins, and logistics also account for differing costs across the market. Okay? You have to consider market factors, the income level, GNP per capita, with GNP, gross national product, and then or GDP per capita, GDP, gross domestic product. What's the difference between the two? Okay? Domestic GDP, everything that's made in this country. GNP includes, in addition to what's made in this country, include also what companies produce in other countries. American company produce in other countries, those are part of American GNP, but not GDP. Okay? Then the consumer's disposable income, the income after tax. You have to look at the price elasticity. Okay? For higher income people, there's a lower elasticity. For lower income people, they have higher elasticity. Okay? The importance of reassessing income level in developing countries. Okay? Cultural factors. Okay? Cultural factors. In some cultures, like in Chinese market, they like number eight, but don't like number four. But eight means prosperity, same sound as prosperity. Four is similar sound to death. Okay? Market factors, right? In culture-wise, bargaining is common in some cultures, such as Turkey. Websites encourage Chinese consumers to form buying teams, called Tuango buying teams, to demand quantity discount from retailers. Okay? Kind of like a Groupon thing. Okay? Market factors, the buying power. The fewer buyers there are in the market, the more powerful they become, because they are better able to bargain for low prices. Okay? Large individual buyers can become important to supplier firms. These buyers can demand lower prices from suppliers. Okay? Um, Market factors, competition. Intensity and power of competition can affect price levels. Okay? So suppliers can enjoy greater pricing flexibility. Large number of competitors can encourage price wars, therefore lower the price. Sometimes price levels are manipulated by cartels or other agreements among local competitors. That could be illegal, though, right? U.S. companies are forbidden. Remember, U.S. companies are forbidden by U.S. law to participate in any cartel. Okay? Just don't do it. Environmental factors, exchange rate fluctuations. When currency weakens, firms' exports are more attractive. When currency strengthens, firms' exports are less attractive. You can see why, right? If you don't understand that, I need to go back to previous chapters to understand that. Okay? Inflation rates. In high inflation countries, companies may price in a stable currency, translating prices into local currency daily because it changes so much, varies so much. You better do that. Otherwise, you're going to be losing money on exchange rate. Environmental factors, the price controls. There could be price controls instituted by the government and the regulatory agencies. Right? The two types, across the board or industry specific, that you have to abide by. Okay? You have to obey. Okay? There are other environmental factors affecting your price. One is called dumping. Dumping, you've heard about dumping or anti-dumping. What's dumping? Dumping. You dump something, right? Dump something into a dumpster. You're selling a product at a price below actual cost. If you're selling a product in the market at a price below actual cost, that's dumping, right? The WTO anti-dumping actions allowed if sales at less than fair value, there is a material injury to domestic industry, okay? And then you can take anti-dumping actions. Okay? And limits firms' price flexibility in overseas market, but protects domestic market from foreign competition. Who pays for the exporting cost? When you do engage in importing, exporting, you will hear the terms about the quoting, how they quote prices. One type of price is called, this price is a CIF. Right? What does that mean? Cost, insurance, freight. Seller pays insurance and transportation to foreign port of debarkation. Okay? There's also called CFR price. That's the cost and freight. The seller pays for transportation. Okay, that's in your test. Okay, CIF, CFR, or FOB, and FOB is free on board. The seller only pays to deliver goods to the port of export. You handle the transportation and of course the cost of the goods. Okay, just FOB. Okay, price. Letter of credits. In import-export, they don't just issue a check or pay cash for import-export. They use a letter of credit. It's the most frequently used method for payment for international transactions. Basically, this is how it works, right? The players in letter of credit or LC are the exporters and her bank, and the importer and her bank. Two banks involved here, right? The letter of credit is issued by a bank at the request of a buyer. You're the buyer, you require a letter of credit at a bank. Okay? The bank promises to pay a specified amount of dollars on presentation of documents stipulated in the letter of credit, like a bill of lading or consumer invoice with description of goods showing that the goods has indeed been delivered, and then the bank will pay the seller to pay the seller the money. Okay? Letter of credit. Letter of credit. The process of letter of credit is the first is purchase. The purchase agreement made between exporter and importer, right? And then is opening of letter of credit. The importer applies for letter of credit in your bank, open letter of credit with exporter's bank, exporter notified. Okay? And then shipment. When exporter ships the goods and the document and sends the documents to his bank, who forwards them to the importer's bank, who notifies the importer goods are on the way. Okay, and then the payment, right? Importer remits payment, cash or credit. Importer's bank sends the funds to exporter's bank, and the exporter is notified. That's how it works. Okay. Letter of credit is beneficial to both importer and exporter. It actually is a good way. Okay? And it substitutes the credit of the bank for the credit of the buyer. Okay? You don't have to rely on the credit of the buyer. They can rely on the credit of the bank. Okay? That's benefits to the exporter. There are benefits to the importer as well. The importer, you do not need to pay until documents and order are actually arrived. And actually arrived, providing additional flow of credit to make your money safe. Okay. Another issue concept here is called transfer price. What is transfer price? The transfer price is the price paid by importing or buying unit of a company to the exporting unit of the same company. Okay, that's called transfer price. Right? It don't represent the arm's length negotiations. It frequently differ from market prices. The transfer price, right? They may charge, company may charge their own unit, at a lower price or higher price, depending on the issues they consider. The firms may deviate from market price to maximize profit or minimize risk and uncertainty. And they can accumulate more profit in a low tax country. And the country has low tax, they can accumulate more profit, so they save on that. They can repatriate profit from a country with limits on profit repatriation. Okay? They can move profits out of country with macroeconomic instability. Okay? They can reduce tariff duties by quoting low transfer prices to high tariff country. You can see that's how companies are doing to avoid taxes. Of course, the government may not like it, right? May not be happy with that. There could be tax issues, right? Transfer pricing issues to consider, the issue for you to consider, internal considerations. It's hard to motivate subsidiary managers when profit motive is taken away. Okay? The company resource allocation may be insufficient. Okay? Externally, there could be problem here with the U.S. government or IRS. U.S. Revenue Act of 1962, Section 482 stipulates that. And the IRS also look at that. They want to look at market price. That's preferred by the IRS. So as for a company to less likely to dodge on their tax obligations. Okay? Foreign exchange market and international pricing. And foreign exchange market is considered the most liquid market. Lots of money change hand, every day. Approximately 1.5 trillion, 1.5 trillion US dollars changes hand every day. That's the daily volume. It's a 24-hour market. When we are asleep, the other side of others is at work. Okay, it's a 24-hour market, so it's largely unregulated. It's unregulated. It's hard to regulate. Okay, foreign exchange market, $1.5 trillion. Quoting price in a foreign country, there is the transaction risk. You to quote the price in another country, there's transaction risk. What is transaction risk? A risk that a change in exchange rate may occur between the invoicing date and the settlement date of the transaction. You give them the invoice, you quote them the price, but when the goods are finally delivered, that's in future date, maybe 2 months, 3 months from today. Right? What if the exchange rate changed? There's a risk here. There's a transaction risk, right? So what do? Right? Foreign exchange price quotation. You can quote a spot price, the number of dollars to be paid for a particular foreign currency purchased on or sold today's price. Or you can quote the forward price, the number of dollars to be paid in foreign currency bought or sold in 30 days or 90 days or 180 days from today. Yeah, that will be forward price versus spot price. Right? And there is a spot contract example here. An ABC company must pay an invoice from a British supplier in Great Britain pound, British pound, right? The company will enter into a contract with this bank to buy British pound 1.5 million British pound at 1.465. Okay, that's example here, right? And then 2 business days forward, the bank delivers the pound per the instructions of the company. Okay? Then ABC pays back 2.197,500 on spot date if the credit line is in place. Okay? And then XYZ, a US importer, okay, import exporter contracts with a Swiss company to ship a custom machinery order upon completion in 3 months. Okay? That's a forward contract. Okay? And the payment terms are open account with payment due after the shipment. Yeah, open account with payment due after the shipment. Okay? The U.S. exporter will choose to lock in the dollar value of the Swiss francs to be received in order to protect the profit margin. Okay? You choose to lock in the value. Okay? The company enters into a forward contract and on this deal. Okay? So in quoting a price in foreign currencies, there are several options for you. Okay, first one is uncover the position, right? You pay spot on the due date, so you're not covered for the risk of currency fluctuations, right? Or you can cover that through money market. You borrowing funds in currency at a risk for the time until settlement. Okay, it covers through money market. Or you can do hedging, right? Hedging. You can contract through financial intermediaries for future delivery of foreign currency at the set price. The set price. Now, regardless how the spot price at the time can be. Okay? So of course you have to pay for that to set the price, to get a set price. And expect the spot versus the present forward rate. Okay? That's hedging. Okay? This is example of hedging scenario, right? See, like a spot rate of say March 3rd, for it's 1.31, US dollar versus British pound 1.31, okay? These are all three scenarios. Spot rate as of June 3rd, 3 months from now is 1.2. It could go down to 1.2. The dollar will increase and pound decrease. It could change from 1.3 to 1.4. That is the dollar is more expensive, pound is less expensive, or it could remain the same. If it remains the same in under scenario C, then dollar equivalent of 18 million as spot rate is 24 million, $24 million, right? There's no change in that, so you do not suffer any loss or gain anything from that, right? In the case when the exchange rate changes from 1.3 to 1.2, the US dollar equivalent of 18 million becomes 21 million, right? 21, almost 22 million. There is a loss of $2 million, yeah, in exchange. Right? If dollar becomes stronger from 1.31 to 1.45, the 18 million is now worth 26 million US dollars. Then you gain $2.5 million. Right? That shows the hedging scenario you can expect to get. Okay. Parallel imports. Another concept in the pricing is parallel imports. What is parallel imports? Right? When cross-market prices are large, individual buyers or independent entrepreneurs buy products in low-price countries for re-export into high-price countries. This would create a parallel market or parallel imports. Right? It's called green market. Green market. For example, someone may buy your textbook. You know, your textbook may cost 150, $200 hard cover. Someone may buy the same textbook, soft cover, in another low price country, like in Mexico, and then sell them back to the US. Right? Same textbook, just different cover. You know, soft cover was a hard cover. That is called, which of course is not authorized by the seller, but it's not purely illegal. Uh, that's why it's called the green market. Okay? Green market. Some of my students are used to be able to buy green market textbooks cheaper. Okay? The cost of green market is because of exchange rates changes, the regional currencies, different competitive pricing, right? Problem with synchronizing supply and demand, ease of moving products across borders, and of course the internet. And how to combat the gray market, to fight the gray market, you can confront the distributors. Okay? They're not authorized to do them. You can cut price, you can interfere with the supply, you can use the price corridors, or you can lobby for legal change. Okay? That's what you can do to fight the gray market. Also manage how to manage response to green markets. You may want to customize product to different market. Therefore, they're not the same. Right? You can maintain control over distribution and subsidiaries. You can alert consumers to potentially pitfalls of buying parallel imports, such as nullified warranty. You can limit supplies of product into low price markets. You can keep prices within the range of each other to discourage the arbitrage, discourage arbitrage. The example of showing Big Mac prices, okay, in US dollars, also the percentage difference of local versus US price in different countries. Right? In US dollar, of course, it's $3.54 for Big Mac. Okay? For Argentina, they changed that reduced by 7% to 3.3. In Australia, they reduced further to $2.9, $2.19, right? And this all reduced. You know, any increase? Yes. In Euro area, they actually increased by 24% to $4.38. And you can see in Malaysia, they reduced a lot, only about $1.50, half of what we pay. Okay? They judge prices here. Counter trade. Let's talk about counter trade. What's a counter trade? Okay? Barter is one. Basically, exchange of real goods. Instead of paying cash, money, they just goods for goods. Exchange, trade goods. Right? That's called barter. Right? You give me something, I give you something in return. No cash, no money involved. Just goods for goods. Right? That's barter trade. Right? And or some there are other counter trade ways to counter trade using compensation arrangement. The value of export delivery partially offset by import transaction or vice versa. The export partially offset by import or vice versa. You know, versus a full versus a partial, or could use triangular agreement to compensate, right? Also in counter trade, there is something called offset. That is a selling company guarantees to use some products or services in the buying country in the final product. It's called offset. Or cooperation agreements. That's a buyback arrangement where payment for input goods is paid for by output goods. Okay, that's called a cooperation agreement. That's also a form of a counter trade. Okay. I think that's pretty much all I have.